Welcome to your comprehensive guide on smart crypto investing beyond Bitcoin and Ethereum. This presentation will provide you with a clear framework for researching altcoins for long-term investment potential. Whether you're new to cryptocurrency or looking to diversify your portfolio, these research methods will help you make informed decisions based on fundamentals rather than hype. Diversifying your investments across multiple cryptocurrencies can potentially reduce risk and increase exposure to different blockchain innovations. While Bitcoin and Ethereum are established, smaller projects with solid fundamentals may offer greater growth opportunities from lower market capitalizations. Additionally, many altcoins are developing solutions to blockchain limitations or addressing specific industry needs that the major cryptocurrencies don't focus on. The cryptocurrency ecosystem has expanded dramatically since Bitcoin's creation in 2009. Today, there are over 10,000 different cryptocurrencies, each with unique features and use cases. While Bitcoin and Ethereum command the largest market share and attention, they represent just two approaches to blockchain technology. The broader altcoin market contains projects focusing on privacy, scalability, interoperability, supply chain improvements, and entirely new consensus mechanisms. The HODL philosophy for altcoins involves three main strategies: short-term trading, medium-term positioning, and long-term holding. Short-term trading is characterized by frequent buying and selling based on market movements and technical analysis, often resulting in emotional decisions and tax complications. Medium-term positioning holds coins for several months to capitalize on market cycles and project milestones, requiring regular portfolio reassessment. Long-term holding focuses on fundamental value and long-term potential, typically involving holding through market volatility. This presentation emphasizes the long-term holding strategy, which requires thorough initial research and periodic reassessment rather than reaction to short-term price movements. Emotional traps and the cost of following hype can significantly impact your investment outcomes. Fear of missing out, FOMO, often drives impulsive purchases at market peaks, while falling for pump-and-dump schemes promoted by influencers can lead to significant losses. Panic selling during market corrections after buying at higher prices is another common pitfall. Research shows that emotional investors typically underperform the market by 1.5% to 4% annually, and in volatile crypto markets, this gap can be significantly larger. A study of 2017-2018 eco-investors found that those who purchased based solely on social media recommendations lost an average of 70% of their investment within 18 months. A research-based approach to investing in altcoins involves several key components: fundamental analysis, risk evaluation, community assessment, and market analysis. Fundamental analysis examines the project's purpose, technology, team, and tokenomics to determine intrinsic value. Risk evaluation assesses competitive threats, regulatory concerns, and technical vulnerabilities before investing. Community assessment considers user activity, user adoption, and community engagement for growth potential. Market analysis looks at market capitalization, liquidity, and exchange listings to understand investment dynamics. This cyclical process should be repeated periodically to reassess your holdings as projects evolve and market conditions change. A strong unique value proposition is often the difference between projects that thrive long-term and those that fade into obscurity despite similar technical capabilities. Key questions to ask include: what makes this project different from competitors? Does it offer meaningful improvements or just minor tweaks? Can its advantages be easily replicated by others? Does its uniqueness provide lasting value or just novelty? Examples of strong unique value propositions include Ethereum, the first programmable blockchain enabling smart contracts and decentralized applications; Polkadot, which offers cross-chain interoperability allowing different blockchains to securely communicate; and Filecoin, a decentralized storage marketplace with economic incentives for reliable hosting. The white paper is a critical document that outlines the project's vision, technical architecture, and tokenomics. The executive summary should start with an overview to quickly understand the project's purpose, target problem, and proposed solution. This section should be clear and concise, avoiding technical jargon. The technical architecture examines how the technology works, even at a basic level, and looks for clear explanations of consensus mechanisms, scalability solutions, and security measures. The tokenomics section focuses on token distribution, total supply, emission schedule, and within the ecosystem. Be wary of excessive allocations to founders or insiders, as this can indicate potential red flags. When evaluating a white paper, watch for red flags such as plagiarized content, vague technical descriptions, unrealistic claims, and missing roadmap or milestones. Plagiarized sections from other projects' white papers indicate a lack of original thought or even fraudulent intentions. Vague technical descriptions without specific technical details often mask the absence of a viable product. Unrealistic claims about solving all blockchain problems or guarantees of investment returns should trigger immediate skepticism. Look for reasonable, achievable goals. Missing roadmap or milestones with no defined timeline suggests poor planning. Quality projects provide specific, measurable milestones with reasonable timeframes. Evaluating the team behind a cryptocurrency project is crucial. Key team attributes to evaluate include technical expertise relevant to blockchain development, previous experience in successful projects or startups, academic credentials in computer science, cryptography, or related fields, business acumen and industry connections, and communication skills and transparency with the community. Start with the project's official website, which should have detailed team profiles. Cross-reference with LinkedIn and GitHub profiles to verify credentials and assess development activity. Check interviews, conference presentations, and AMAs to evaluate how team members communicate their vision and handle difficult questions. When assessing a team, watch for red flags such as anonymous team members, misrepresented credentials, previous failed projects, and excessive focus on marketing. Anonymous teams may have legitimate reasons for anonymity, but it typically increases risks as team members cannot be held accountable. Misrepresented credentials, such as claiming associations with prestigious companies or universities that cannot be verified, are significant red flags. Previous failed projects or involvement in scams without reasonable explanations represent a significant risk factor. Excessive focus on marketing by teams with few technical experts often prioritizes hype over development. Look for a balanced team with strong technical and business expertise. Tokenomics is a critical aspect of a cryptocurrency project, encompassing how tokens are created, distributed, and used within the ecosystem. Strong tokenomics align incentives between users, developers, and investors while supporting the project's long-term growth. Key components include token supply, distribution, utility, and vesting and lockups. Token supply considers total, circulating, and maximum supply numbers, and whether the supply is deflationary, inflationary, or fixed. Distribution examines how tokens are allocated between team, investors, community, treasury, etc. Utility focuses on the token's function within the ecosystem, supporting demand beyond speculation. Vesting and lockup schedule token releases, especially for team and investors, to encourage long-term commitment. Evaluating token supply models involves understanding deflationary, fixed supply, and inflationary models. Deflationary models see the total supply decrease over time through token burning or unclaimed rewards, potentially driving value appreciation if demand remains constant or grows. Fixed supply models have a maximum supply that is capped and cannot be changed, like Bitcoin's 21 million cap, providing potential benefits of increasing scarcity with no dilution risk. Inflationary models create new tokens continuously, often to pay for network security, with examples like Ethereum and Solana. The ideal supply model depends on the project's purpose, with security-focused networks often using inflation to reward validators, while store-of-value tokens benefit from scarcity. When evaluating tokenomics, watch for red flags such as excessive team allocation, short or no vesting periods, unclear or changing supply, and limited token utility. Excessive team allocation, where more than 20–30% of tokens go to the team, may prioritize personal enrichment over project success. Short or no vesting periods for team and investor tokens can lead to early dumping. Unclear or changing supply models show poor planning, and transparency about token creation and distribution is essential. Limited token utility, where tokens are not used beyond speculation, can hinder long-term value. Strong projects create genuine utility that drives organic demand for their token. Development activity is a core research pillar, with metrics like abandoned projects, success correlation, and top 50 correlation providing insights. 67% of cryptocurrencies from 2017–2018 that showed no code commits for 6+ months were abandoned. Projects in the top quartile of developer activity were 3–5x more likely to succeed long-term compared to those in the bottom quartile. The percentage of top 50 cryptocurrencies by market cap that maintain above-average developer activity shows strong indicators of project health and long-term potential. Active development shows the team's commitment and ability to adapt to changing market and technology conditions. Tracking developer activity involves monitoring GitHub metrics like commit frequency and recency, number of active contributors, issue resolution rate, and code quality and documentation changes. Tools like CryptoMiso, GitStats, and CoinCheckup can help track developer activity across projects. Beyond GitHub, not all development is visible on public repositories. Consider technical blog posts and documentation updates, testnet launches and upgrades, bug bounty programs and security audits, technical discussions in developer forums, and progress against published roadmaps. Community engagement is a vital aspect of a cryptocurrency project's success. Look beyond member counts to assess the substance of community conversations. Healthy communities discuss technology, use cases, and development updates rather than just price speculation and memes. Moderation and governance are crucial, with communities having clear rules and transparent governance processes indicating professional management. Geographic distribution is also important, as international communities are more resilient than those concentrated in a single region. This diversity helps mitigate negative regional regulatory challenges and build global adoption potential. Community strength often determines whether similar projects succeed or fail. A passionate, knowledgeable community creates network effects that drive development and growth. When evaluating community engagement, watch for red flags such as price fixation, cultish behavior, bot activity, and inactive official channels. Communities focused almost exclusively on price movements and, to the moon, predictions often lack substance. Quality projects discuss technology and adoption more than price. Cultish behavior, where members attack anyone expressing doubts, is a red flag. Healthy communities welcome reasonable skepticism and questions. Bot activity, with long periods of repetitive messages or generic praise, may indicate astroturfing. Inactive official channels, where team members provide few updates, suggest poor communication and management. Regular, transparent communication is essential. Real-world adoption is the ultimate test of a cryptocurrency project's success. While many projects have impressive technology, long-term success depends on actual usage and adoption. Projects solving real problems for real users have stronger foundations than those with theoretical benefits only. Metrics like adoption rate, valuation impact, and survivor rate provide insights. Less than 5% of projects achieve real-world adoption within their first 2 years. Projects with verifiable usage metrics typically maintain valuations 8x higher than comparable projects without them. The percentage of projects with documented real-world use cases that survived the 2018-2020 downturn was greater compared to 24% of purely speculative projects. Measuring real-world adoption involves examining transaction count, active addresses, and value transferred. Look for genuine activity patterns rather than artificial volume. Tools like Glassnode, Into the Block, and Blockchain Explorers provide these insights. DApp usage is important for supporting decentralized applications, evaluating active users, total value locked, TVL, in protocols, and partnerships with established companies that go beyond superficial announcements. The developer ecosystem, including third-party developers and companies building on the platform, is crucial for long-term adoption potential. A strong network of independent projects indicates strong adoption potential. Market capitalization is a key metric in evaluating the value of a cryptocurrency. It is calculated by multiplying the current token price by the circulating supply, representing the total value of all tokens available in the market. This metric provides a more accurate picture of a cryptocurrency's valuation than price alone, as it accounts for supply differences. Large-cap projects often have significant adoption and market presence, while mid- and small-cap projects offer higher growth potential but with varying degrees of risk. The relationship between market capitalization and growth potential is crucial for setting realistic investment expectations. Larger market caps often indicate stability but lower growth potential, whereas smaller caps can offer higher growth but come with increased risk. Understanding this dynamic helps investors make informed decisions about where to allocate their resources. Liquidity is a measure of how easily an asset can be bought or sold without affecting its price. High liquidity enables efficient trading, reduces transaction costs, and minimizes vulnerability to market manipulation. Several metrics, such as 24-hour trading volume and order book depth, help assess a cryptocurrency's liquidity, ensuring more accurate price discovery. Security is paramount in the cryptocurrency space. Evaluating code quality, network security, and security history helps determine a project's resilience against vulnerabilities and exploits. Projects with robust security measures are more likely to gain user trust and demonstrate longevity in the market. Security red flags can significantly impact a project's credibility. Technical vulnerabilities, such as inadequate security audits and closed source code, along with operational security issues like poor key management practices, can deter investors. Projects that prioritize security in their development and operations demonstrate greater longevity and user trust. Regulatory considerations are crucial for cryptocurrency projects. Compliance measures, legal structure, and jurisdictional challenges can affect a project's ability to operate globally. Understanding these factors helps assess the project's potential for regulatory scrutiny and its adaptability to changing regulations. The regulatory landscape for cryptocurrencies has evolved significantly. From minimal oversight in the early days to comprehensive frameworks today, projects must navigate complex global requirements. This evolution impacts innovation, compliance, and the overall growth trajectory of cryptocurrency projects. Understanding the competitive landscape is essential for assessing a project's long-term viability. Evaluating direct and indirect competitors, advantages over alternatives, and market fragmentation helps determine the project's potential for success within its niche. This analysis guides strategic positioning and growth potential. Decentralization is a key value proposition for cryptocurrencies, offering censorship resistance and governance transparency. Assessing node distribution, consensus power, and governance structures helps understand how decentralized a network truly is, balancing efficiency with decentralization benefits. The blockchain trilemma refers to the challenge of achieving decentralization, security, and scalability simultaneously. Different projects prioritize these aspects based on their use cases and philosophy. Bitcoin, Solana, and Ethereum each offer unique approaches to balancing these critical properties. Economic incentives are designed to maintain network security and sustainability. Validator, user, and developer incentives play a crucial role in aligning interests and ensuring the ecosystem's resilience. Examining these incentives helps understand the project's long-term viability and growth potential. Sustainable cryptocurrencies require robust revenue sources to fund security and development. Transaction fees, inflation funding, and ecosystem value capture mechanisms are essential for covering costs. Projects with consistent revenue face fewer sustainability challenges, ensuring long-term growth and stability. Effective risk management involves thoughtful portfolio allocation across different risk categories. Balancing investments in established altcoins, growth potential projects, and speculative ventures helps achieve potential returns while preserving capital. This strategy provides stability during market volatility. Position sizing is crucial for managing risk in cryptocurrency investments. Adjusting position sizes based on risk category and correlation considerations helps balance exposure across the portfolio. This approach ensures diversification and aligns with the project's fundamentals, minimizing potential losses. Dollar cost averaging, DCA, is a strategy that involves investing fixed amounts at regular intervals, reducing the impact of volatility and eliminating the need to time the market perfectly. This method offers a disciplined approach to building wealth over time, especially in the volatile crypto market. Taking profits is an essential part of risk management. Setting specific price targets and using staggered exits allows investors to lock in gains while managing risk. Time-based strategies and rebalancing help maintain target allocations and optimize portfolio performance during different market conditions. On-chain analytics provide valuable insights into network health, investor behavior, and market indicators. Tools like Glassnode, Nansen, and Into the Block offer comprehensive data analysis, helping investors make informed decisions based on real-time blockchain activity and trends. Technical evaluation is crucial for assessing a project's development health and security practices. Platforms like GitHub, CryptoMiso, and Santiment offer insights into code quality, activity metrics, and security assessments, guiding investors in evaluating long-term viability beyond marketing hype. Market analysis tools provide comprehensive data on price trends, volume, and market cap. Platforms like CoinMarketCap, Glassnode, and Messari offer valuable insights into market dynamics, helping investors track project performance and make informed investment decisions. Independent analysis offers deep insights beyond basic market data. Platforms like Messari Pro and Delphi Digital provide rigorous analysis, while academic research from institutions like MIT and Stanford ensures unbiased perspectives. This approach helps investors understand projects from multiple angles. In the world of information filtering, recognizing quality sources is crucial. Hallmarks of quality include transparent methodologies, verifiable data, and nuanced perspectives. On the other hand, red flags such as excessive use of hyperbole and cherry-picking data can indicate unreliable sources. Being able to distinguish between these can significantly impact the quality of your research and decision-making. Avoiding common biases is essential in information filtering. Confirmation bias leads us to seek information that confirms our beliefs, while social proof bias makes us follow the crowd. The sunk cost fallacy can trap us in poor investments. By being aware of these biases, we can make more rational and objective decisions. Creating a research framework helps standardize your evaluation process and maintain consistency. It allows you to document and refine your analysis over time. Key components include standardized criteria, scoring systems, and review schedules, which help in making informed investment decisions. A sample evaluation scorecard can help assess various aspects of a project, such as problem fit, team experience, and community strength. By assigning weights and scores, you can objectively evaluate projects and make informed decisions based on a comprehensive analysis. A project research template is essential for organizing your findings. It includes a project overview, key claims analysis, and an assessment of strengths and weaknesses. This structured approach ensures that your investment decisions are well informed and based on thorough research. Beyond technology, human factors play a crucial role in project success. Leadership quality, partnership approach, community culture, and communication style are key elements that can influence a project's trajectory. Understanding these factors can provide deeper insights into a project's potential. Understanding blockchain involves grasping its different layers. Layer 0 facilitates cross-chain communication, while Layer 1 includes base protocols like Bitcoin and Ethereum. Layer 2 solutions aim to improve transaction capacity. Each layer serves a unique function in the blockchain ecosystem. Evaluating different blockchain layer types involves considering security, scalability, and technological approaches. Layer 1 offers strong security but faces scalability challenges, while Layer 2 provides improved performance with additional complexity. Understanding these differences is key to making informed decisions. Crypto market cycles are characterized by phases of accumulation, euphoria, and correction. Recognizing these cycles helps in making rational investment decisions and managing risks effectively. Understanding market dynamics is crucial for navigating the volatile cryptocurrency landscape. Fundamental and relative valuation methods offer different perspectives on assessing cryptocurrency value. Fundamental valuation focuses on intrinsic value, while relative valuation compares metrics across similar projects. Both methods provide valuable insights for identifying potential investment opportunities. The investor mindset goes beyond technical analysis. Creating genuine value, thinking in probabilities, and remaining adaptable are key aspects. Developing conviction through research and balancing conviction with adaptability can lead to more informed and resilient investment strategies. Putting it all together, your research checklist should include solving the problem, evaluating the team, analyzing tokenomics, and assessing development activity. This comprehensive approach ensures that your investment decisions are based on thorough and systematic research. Continuing with the research checklist, consider market factors, assess security and risks, and determine investment strategy. Documenting your findings for future reference ensures that your research process is thorough and adaptable as projects evolve. Research in practice involves continuous learning. Keeping journals, building knowledge systematically, and learning from mistakes are essential. Engaging with research communities can provide valuable feedback and accelerate learning, helping you refine your research skills over time. In conclusion, the researcher's edge lies in systematic research and continuous learning. By developing strong research skills, you position yourself for potential financial returns and a deeper understanding of transformative technologies. Accessing research resources and joining communities can further enhance your research journey.